Hey guys, Frugal Samurai here. I just wanted to quickly say that the whole world has seen a massive outpouring of support for awareness and cultural change. I want you to know that I support this movement and it's time for elimination of systemic racism and a time for equality. With that being said, let's get into the video.
Hey YouTube, welcome again to my channel, Frugal Samurai here, hoping everyone is safe and well. You might have heard it before, Australia is actually currently in recession. In today's video, I'll be talking about what is a recession, what can we expect from a recession, what happened in the last recession, and most importantly, how can we prepare for this recession. The official definition of a recession is 2 consecutive quarters of negative economic growth. What that means is the economy declines in a 6-month period. The latest economic data was from the March quarter, which is January, February, and March, which said that Australia actually declined 0.3%. That was probably because of the bushfires, the droughts, and the floods that occurred in the tail end of 2019 and early 2020. Given the lockdowns of the June quarter, the economy will most likely contract, in which we get 2 consecutive quarters of declining economic growth and hence Australia in recession. Now, most of us who were too young to remember or weren't even born yet almost 30 years ago, that includes people like myself, millennials, Gen Y, Gen Z, or even some Gen Xers, this is what happened. It's undeniable that it was actually a terrible time for the average Australian. Unemployment peaked to around 11 to 12%. Official interest rates were sitting around 17.5%, which meant that mortgages and home loans was around 20%. Commercial loans for businesses was north of 20%. Imagine paying 20% on your mortgage rate at the moment. That is madness. One of the main factors that caused that recession was because of corporate greed and speculation in the 80s. So what happened was companies were actually taking on massive debts to generate big profits, but also to engage in rampant speculation. And then it all ended when central banks around the world increased interest rates to prevent a rise in inflation. Inflation is the general rise in the price of goods and services. When interest rates rise, this means that the cost of borrowing increases, which means that the amount companies needed to service their loans increased, which means that there was less cash flow for them to service, and the snowball effect meant that many companies went out of business. This had a flow-on effect for the economy. This recession is different because it was actually self-imposed. This means that it is unique in the sense that in March, the government actually issued a directive to effectively halt all community interaction and business activity. This differs from a typical recession, which generally follows after a period of substantial growth, speculation, and general excess. Also, this time round, official cash rates are at record lows, 0.25%, and we've also had billions of dollars being injected into the economy in terms of stimulus packages such as JobSeeker and JobKeeper. So what can we expect from this coming recession? At the moment, it's still too early to say. As COVID-19 rages on in other parts of the world, so we're seeing peak cases increasing in the US and also India and Brazil, forecasts and predictions is anyone's guess. The future is unclear until we get a handle on what I believe are 3 things. 1 is how to best manage the caseload of COVID-19 cases globally. 2 is when a vaccination is found. Some people say 12, some people say 18 months away. And 3 is how consumer confidence will bounce back when the economy starts to reopen again. As you can imagine, there is plenty of debate to the economic path going forward. Some people have said that this coming recession will be the worst one since the 1930s, aka the Great Depression. But look, I don't think we will. Now, others say that economic growth will follow a V-shaped recovery, which means that the economy will snap back once the peak virus cases has passed. I'm somewhere in between. I think we'll probably have a U-shaped recovery or a W-shaped if there is a second wave. Generally, in recessions, the following occur. There is higher unemployment as businesses and companies make less money, which means there is less money going towards payroll. And this means that there is going to be increased likelihood of job uncertainty, and also it's going to be darn difficult to switch jobs. Correspondingly, there will be a drop in wages and a fall in income, which means that there is going to be less money available to spend. So there's going to be another drop in consumer spending and confidence. And what we will see is potentially a fall in asset prices, which means that there's going to be a drop in property values and also share prices as a reflection of the economic conditions and confidence in the market. How long does a recession normally last? Until it ends. But what you will find is since the 1960s, a recession typically lasts about 6 months, except for the one in the early 1980s, which lasted about 2 years. Well, with property, most commentators would agree that there is going to be a 5 to 10% fall in property prices in the short term, with continued growth in the long term. In saying so, there have been those commentators earlier on during the lockdown period who said that property prices would drop 30, 40 and more, but I don't think that's going to happen. What I am expecting is housing transaction activity to fall substantially, because there is going to be less demand on people looking to buy and to move house, and there will be less supply as people will not be as inclined to sell their property. But what you will find during a recession is that people who are forced to sell will sell, either through financial hardships or perhaps some other personal reasons like a divorce or a deceased estate. The good news is that the banks and lenders are actually offering us 6 months repayment holidays during this current time, which means that we do not actually have to make any repayments for 6 months. Just be careful with that, guys, because it's not free money. It's not as if you don't have to pay that money back. You will have to pay that money back eventually, because it gets added on to the end of your loan, which means that your loan balance increases, and that means that your subsequent interest repayments increases as well. A lot of you know that the majority of my net wealth is actually held in real estate, so I'm more than happy to do another video on real estate investing in terms of what properties to buy, how to be a successful real estate investor, and also what to look out for later on down the track. Now, the other major asset class obviously is shares. With shares, typically prices are forward-looking, and what this means is currently they are pricing in a V-shaped recovery. Now, of course, whether that is right or wrong, no one has a crystal ball, so no one will know. But I can tell you that if there is a second wave, then all bets are off. With investing in the share market, you are actually buying a piece of a business. So it is vitally important that you understand what business you are buying into and how that business has been impacted by COVID-19 going forward. Now, how best to prepare for a recession? First one is to be alert but not alarmed. Be aware that the economy operates in cycles. Recessions always offer up opportunity as well as a transfer of wealth. As an example of this opportunity, we saw some share prices of companies like Zoom skyrocketing because of the shift to remote working and working from home. There is always opportunity in the market, which brings us to number 2, and which is to think long term. You don't want to make 30 years of investment decisions based on the last 30 days of a news cycle. You want to be able to diversify and try not to time the market, because it's very important to remember that recessions are typically driven by how the population thinks about the economy as opposed to the economy itself. This is because people always overreact. So bargains in the property and share markets will eventually occur. This is why it's so important to have spare cash available to invest to take advantage of these opportunities. Now, I've done an earlier video on this topic, personal finance habits for today. You can check it out in the links below in terms of how to best build an emergency fund. In conclusion, I'm not here to scare anyone. I don't want people to panic and go out and yell from the rooftops, oh, the Frugal Samurai said this, the Frugal Samurai said that. Yes, the Frugal Samurai said this because he wants you to understand what to expect. You want to prepare for the worst, but hope for the best. The most important thing is don't overreact. Keep an independent mind and stay calm at all times. Oh, and very importantly, guys, all information here is general advice only. Please do your own research and all opinions are my own. And if you can do me one big favor, please let me know in the comments below what other videos you would like me to do, and I'll be more than happy to do them in the coming weeks. If you like this video, hit that subscribe button below, click the bell, turn the notifications on, and I will see you next time. Bye all. Look, I think today's video is actually going to be on the dreaded R word. As an opportunity of this example,